Welcome to Course 1, Unit 3, Lesson 2, Stock Market Crashes and Market Bubbles. In this lesson, we have 3 lesson objectives. The first is an introduction to fear and greed cycles. The second is understanding Warren Buffett's opinion on market psychology. And the third is understanding the accumulation of shares versus trading assets. So let's get started. I want everyone to imagine that they're standing on a city street and they're just kind of minding their own business, looking around, when all of a sudden they see a rampage of people just start running down the street directly towards them. You have very little time to react, but you just see this mass group of people running directly towards you. How would you react to that scenario or that situation? As most people think and contemplate that question, I'm sure that you would probably turn in the same direction as the crowd of people and start running with them. It's not that you had to ask them why they were running or where they were running or what they were running from. Your natural instinct, your human instinct, is to turn with the people and start running. You might not know why, you don't even have to ask why, but your instinct is telling you that you need to get moving and you don't want to continue standing there. So as we look at this scenario, let's say you were in a car and you drove past a nightclub and you're looking for a place to go out for the night, and you drive past this nightclub, which is called Best Nightclub on the Planet, and as you drive by you see a long line of people standing there and they're all waiting to get in. So what would be your natural inclination on where you should go that night and which nightclub you should choose? And so a lot of people would see the long line and think, wow, this nightclub has to be awesome. It has to be one of the best places I could go tonight. So they get in the long line and they wait to get in. So what we're talking about here are human instincts. In the first scenario, we were describing something that was fearful, in that you were standing on a street and a mob of people come running at you. And so your instinct is that you need to turn and run and get out of there because something bad's about to happen. And the second one, you saw a group of people all standing in line waiting for something that has to be good. The only reason people would be waiting in a long line like that is because something has to be good on the inside. And so you're willing to see what that is, and you're following that crowd's tendency to wait in the line. So what we're talking about are instincts. And an instinct is described as any behavior is instinctive if it is performed without being based upon prior experience or knowledge. And the 2 words that I highlighted there, or that I underlined, were without and knowledge. And I really want you to remember those 2 words as we go through this lesson. So I gave 2 examples of everyday occurrences that people could really quickly relate to and understand. And that's what a lot of people forget about whenever they understand how markets move in the short term. When I mean short term, I'm just meaning a couple years, so 3 to 4 years. I consider that short term. I consider like 25 to 30 years long term. So when we're talking about how the markets move in the short term, you got to understand the fear and greed cycles. And in our scenario, we were talking about people running down the street. That's obviously our fear cycle. And then the greed would be you waiting in the club to get in there and meet fancy people and to have a great time. So when we talked in the last lesson about Mr. Market, we understood that Mr. Market is that person that would be giving you those clues to be an instinct-based trader. So since most investors base their investing on emotions and instinct, they follow the mindset of Mr. Market. And remember, instinct is without knowledge. So the solution to this is that we got to become knowledgeable. We got to base our decisions on facts opposed to emotions. So as we look at this picture, you can see when Mr. Market's up there yelling, "Hey everybody, come on in. I'm making money, you can make money, and my neighbor can make money." That's your greed cycle. The mindset during the greed cycle is that a quick buck can be made and that it's going to take very little effort on your part in order to make some money. And so what you have is you have traders who get in for one day and they make 10% on a stock and they quickly sell it and they think, oh, I'm going to throw it into another one, and they make some more money on that. And next thing you know, they're day trading and they're doing this consistently day in and day out, and they're making some money doing it. And then what happens is the market corrects because you have value-based traders who actually know what the value of those assets are, and they start trading them down because they're too high. And then what comes is the fear cycle, because people start getting scared because they're losing small amounts of money, then they're losing larger amounts of money. The next thing you know, they lose an enormous sum of money, and most people get very scared. And then the mindset shifts from making a quick buck to, I don't know the value of these stocks and I don't really know what I'm doing, so I'm out of here. And what they do is they sell all their shares and they lick their wounds, and they realize that the little bit of money that they did make, they probably lost it, or maybe even worse, they lost more than where they started out. So how do we know what the stocks are worth is the tough question, and that's what we're really going to learn in Course 2. But I think we can all agree that the knowledge of a stock's value allows an investor to determine if Mr. Market is greedy or fearful. If we know what that stock's worth, well, then we know if the price is overvalued or the price is undervalued. And that's really the important thing here, is that we have to know what the stock's value is. And so Warren Buffett's opinion on this market psychology, he says the key is to be greedy when others are fearful and to be fearful when others are greedy. So the name of the game is really accumulating shares versus trading shares. And you want to be the person who's accumulating shares. Now, Benjamin Graham, who was Warren Buffett's professor at Columbia, he has a wonderful quote where he says, "The stock market behaves like a voting machine, but in the long term it acts like a weighing machine." And what he meant by this is, in the short term, anyone can price a stock. Anyone can say it's worth $10, $15, or whatever. But in the long term, the stock is going to be worth what its value is. And that's where you look at the scale there, the value becomes absolute. So what I'm going to do is I'm going to show you two different traders. I'm going to show you a value-based approach, and I'm going to show you an emotional-based approach. Our value trader is Amy, and Trevor's our typical trader who might not really understand all the different financial terms and everything that there is about stocks. So I'm going to go through how the mindset of both of these traders works. So we have Amy on the top, and she's looking at buying stock in a company called American Eagle, which is like a clothing store. And just so you know that these numbers that I'm quoting in this example aren't real stock numbers from American Eagle. I'm just kind of using it as an example. So Amy would look at American Eagle and she would read through all the different financial data, and then she would look at it and say, the company's earnings are $2 a share, and the $18 of book value is a great margin of safety. The 1% dividend is okay. Overall, I think its intrinsic value is probably about $22 a share. So that's how she would look at it. Now, your emotional-based trader like Trevor, he would think, wow, I really like the company American Eagle. I have tons of their clothes. They've got stores in every mall. Every kid in high school shops there. They just opened a new store in the next town over. I'm going to buy some stock in that company. And so that's how Trevor thinks. So what we have is Amy buys 100 shares of American Eagle for $20 a share. So that's a $2,000 investment for Amy in buying American Eagle. And Trevor does the same. Trevor buys 100 shares for $20 each, and so he makes a $2,000 investment, both in the same company. So for whatever reason, we don't even have to understand what reason, but the market drops, and it could be based off of psychology, it could be based off of any number of things, but that's absolutely impossible to predict whether the market's going to go up or down. It's just not something you can predict. And so in this scenario, the market goes down. Okay, and it drops. The shares are not trading for $20, now they're trading for $15. Okay, so this is how Amy would look at that scenario. This is awesome. Although the company had a little less earnings than I hoped for, which is probably the reason it was trading for less, it's still worth at least $20 a share. Since it's trading for $15, I better get some more while it's at a good price. So Amy's looking at this as, oh, wow, so they had a little less in their last quarter's earnings that they reported, but the company's still worth $20, which is a little bit less than what she thought it was worth before. And since it's trading for $15, she's going to even buy more of it because she knows it's a great deal. Now Trevor, this is how Trevor would think. Oh no, what in the world did I get myself into? I just lost $500. American Eagle's a great company. How could it go down so much? I might need to sell this. I could lose everything if it goes lower. Okay, so there's your two different mindsets. So let's go ahead and look at how they react to that. So Amy invests another $2,000, and this time, instead of just getting 100 shares, she gets 133 shares because the market price is cheaper. So now she owns 233 shares of the company. Now we look at Trevor, and he's just going to hold on to his 100 shares. He's a little nervous because he lost quite a bit of money. So let's just say like another 6 months go by, and the stock is still trading down at that $15 range. So Amy's mindset is, I can't believe people are still trading this company for $15. She's getting a little bit frustrated. It's now worth $21 a share based on the new earnings and balance sheet. I'll buy even more shares. Another 133 shares are bought for $2,000, and now Amy owns 366 shares. So Amy, although the stock is still lower than what she thinks it's worth, which is a little frustrating for a value investor, and I'll tell you, there's sometimes that you wait for companies for a year or 2 years before they actually come back to that intrinsic value that you might think that it's worth. But the key here is to think for yourself and to absolutely know that you're calculating the value properly and that you're looking at all the variables right. And so Amy buys some more shares for $15, and Trevor's still nervous. He cannot believe that those shares have gone down so much, and so he's going to continue to hold. It hasn't gone lower, so he's not going to sell, but he's going to hold what he has. So let's say that it's another 3 to 6 months or so, and then the market price comes back up to $24 a share, which is only $4 higher than where they both started. Amy says, man, this thing is trading for more than what I think it's worth. Better start looking somewhere else for a good buy, because this is overvalued. She thinks it's still worth $20 to $22 and it's trading for $24, so she stops buying it at this point. She's invested $6,000, and so then her profit, because the stock is back up to $24, she's made $2,784, which is a 46% gain. Now, the mindset of Trevor is, sweet, I knew this was a great pick. Just made some easy money. I think I'm going to buy some more. So he's going to buy some more at the $24 price because he made some money. He made $400 in profit on his $2,000 investment. And so this is truly the difference between a value-based investor and a person who's really looking at the financial data versus somebody who's making their decisions completely based off of emotions. And you can see, the saying always says buy low, sell high. And when you looked at these two scenarios, Trevor was always buying when it was high, but Amy was always buying when it was low. And whenever that price did get higher than what she thought it was worth, she immediately stopped buying it. And she just held those shares. And if you're buying a dividend share, which I strongly recommend in the second course, you're then going to collect the dividends on that as you just continue to hold it. So something to think about as you look at how you invest versus how other people are investing. So what kind of trader are you? Do you typically sound like Trevor, or do you sound like Amy? And that's something that you're going to have to decide for yourself. And you're also going to have to decide whether you think that that's the right approach for you. Maybe it's not. And here's the question I really want you to think about. In the long term, who do you think is ultimately determining the market price? Do you think Amy's the person who's really controlling the market price, or do you think it's Trevor? And so I would obviously argue that in the short term, Trevor's controlling that market price because he's making it go the Trevors of the world are making that thing go up and down because they're trading on emotion and they're following Mr. Market. But in the long term, Amy is the person who's ultimately controlling the value of that company. So if you'd like to trade shares like Amy, that requires knowledge, not instinct. And if you're looking for how to do that, you've come definitely to the right site. We got tons of tutorials here to help you learn how to be a knowledgeable investor and a value-based investor. And Course 2 is going to teach you all those things that you need to know for calculating the intrinsic value. So that concludes Course 1, Unit 3, Lesson 2, Stock Market Crashes and Market Bubbles. In this lesson, we had 3 lesson objectives, which were an introduction to fear and greed cycles, Warren Buffett's opinion on market psychology, and the difference between accumulating shares and trading assets. And thanks for joining us, and we'll see you in Course 1, Unit 3, Lesson 3.